My name is Michael Guyette, publisher of the Lead Lag Report. Joining me for the air is Francis Hunt, the market sniper himself. By the way, I love that as a moniker for you, Francis. But introduce yourself to the audience. Who are you? What's your background? How'd you get involved in market? And exactly how accurate are you?
Well, good question. Yeah. So, beginning of it all, very early in life, it was kind of funny. My mother came into some money when her mom passed. I was living in South Africa. I was a young boy, the youngest of three. And they bought into unit trusts with those funds at the time. And the year was 1987. And every day, my father was trundling off to work. He drove all the way from Johannesburg to Pretoria, which was kind of a sort of 45-kilometer round trip. There'd been the oil crisis, so they used to carpool with other people that were working in the same sort of governmental sort of state. He was in research at the time. And the interesting thing is I would listen to how, the Guard Bank is up, Old Mutual is up, which were the names. It's a bit like the Vanguards of today, each evening. And I got this impression it's much better to invest to make money than to trundle off to work and do all of this driving. I just felt from a point of view of productivity, this game with coin go up, or equity go up seemed a much smarter way. And I got called into the military, which was compulsory at the time. We did 2 years for our sins. And I put my whole job aloft because I had an aunt who died in England who never had any kids and gave nephews and nieces a stipend. So that was my grub stake. And I was around 18, 19 and I put it in the markets, and that timed it perfectly because I was an August intake and I'd heard nonstop how these things go up. And I put all the money in there, and literally the single biggest stock market crash in a day and then subsequent week occurred. Thankfully, I was too busy being chased around and I started through, and it was within about quite a short recovery cycle. But that was sort of love at first bite. So it was a loser's start for me, very definitely. And that was just investment rather than being a trader. Ref the market sniper moniker. I always consider, accuracy being the sort of interrogation mark or behind the word truth. So I'm essentially a truth seeker. I'm really interested no matter how dark it is. And snipers are known for sort of sitting in the dark and finding comfort in the dark and looking through to the light and shooting the silhouettes of the enemy. So they are creatures of the dark. I remember in the military, we were the most dangerous people. We would be patrolling around at night. And any animal we came across were in deep trouble. There'd be an entire patrol with weapons that could shoot automatically. And in fact, we regularly almost shot each other. We had a guy shoot a round off in training on officers' court that went in between somebody's legs who was walking in front of him. So, we were the most dangerous force, not only to others, but to ourselves, friendly fire, all of this. So it was a really interesting experience. I was also a student of America and Vietnam War. And what I realized when you read the history of sniping, just a short analogy, I suppose, and I'm going to bring this to markets very quickly, but be patient. There's during World War II, 250,000 rounds were expended per actual proven fatality of intent. In other words, a good guy shooting a bad guy. You can decide who's good and bad guys in war. I don't tend to have that framing. In Vietnam, that went up to just under 500,000, 450,000. So you get ever greater automatic weapons, a lot of keep the heads down shooting. And actually, you come to the conclusion that infantry is just there to make a lot of noise by throwing these potentially dangerous pieces of lead into trees and bark to get people to go away. Hamburger Hill, you would go and chase people away and they would go on to the next hill. And then you would withdraw, claiming a victory, and they would come back in. That was the whole Vietnam War type experience. So snipers as a category was typically special forces, a lot more well-trained, much more specific equipment, and their conversion rate was 1.3. So just consider the efficiency of somebody who's expending 500,000 rounds as an infantryman per actually lodging a bullet in an enemy versus someone who expends 1.3 rounds. That means almost every time he's getting a hit. And the difference was a kill as well, because a lot of people can hit somebody, but not actually do any damage, just, in the arm or whatever. Now, again, I'm not a war freak, but from an efficiency perspective, I admired this. And one of the key three reasons that is snipers shoot a whole bunch less. So now let's bring this to trading. The problem, and I was with Boris on an AI in trading session on this Saturday just passed. By the way, guys can probably catch a recording if they feel like it. But the key thing is people have a systemic approach and always in. The best trade is usually no trade. You need to have selection criteria that you're literally asking the planets to line up for you. Because any great system, as Boris was pointing out, he will feed the right data and market conditions that will wreck that system. So you don't want to be always in. Too many people think trading means the doing, and that's order entry. And the order entry is literally clerical, as far as I'm concerned. Yes, you can cock it up, but actually determining that key moment when to shoot, that is why a sniper has that shot. He's not only convinced of the headshot, he's convinced of the between the eyes shot, so that even a small variance in wind still means he's getting a kill shot. The other thing is snipers shot high value targets. They didn't shoot an infantryman. They were observers. They were natural observers of the market. Most of the time, they were lying in a hole in a ghillie suit and crapping in a hole with a spotter doing the same. Most of what they did was observation. That's why they were reconnaissance and many other things. So I'm drawing this one parallel and I'm bringing this back each time. So the whole thing is a game of observation where you're looking for a unique set of circumstances. And then you go big, because when you snipe, if you look at some of the weapons, these are the biggest badass rifles. These things throw big stones and they throw them far, hard and fast. Whatever they hit, they take off. And that's the analogy you want. So I'm comfortable with actually over risking if I'm getting a super tight stop loss and I have known exits. Think about, again, the sniper analogy. These guys rarely got caught. They were the most loathed. If you were a sniper and you got caught by the rivals, they hated you. You know, you would get beaten the hell up. Snipers would tie up entire garrisons for ages and be an absolute menace and have killed multiple of people's friends. By the time they catch you, in deep trouble. So you would have known exits well before. So you will have observed and seen where everybody is, and you know your exits before you shoot. So this is the entry. And the entry and the take profit and the exit which is a stop loss, if wrong, are all there. And the problem, the three big things for being a better trader is no market orders, only limit or take stop orders. So in other words, you're waiting for criteria to be fulfilled so that the market is already self-confirming you into the view that you have constructed. And you have a known risk reward that is disproportionate to the potential probability of the outcome. So we talk about a Pout score, probability of outcome. So there's quite a bit to unpack there, and I've spoken for a bit, but that's the analogy of it. And the truth element comes in. I don't believe anything anybody says generally. I look at the money and the market. The greatest truth in terms of financial aspects is what people do actually with their money, not what they say. So people talk their books, people do a lot of things, but that the big money moves markets, and you see it in the volume, and you see it in price behavior, and you see it in patterns. So everything is, how do I get past all the BS and straight to the hard nails, hard tax truth of the matter? So yeah, let me leave that for you to respond on.
No, that's good. I love that analogy. Speaking of being a truth seeker, you and I both know the expression that price is truth. And I always thought that was a strange concept because price changes every day. And you mentioned the crash that you experienced. It's like the truth of price the day before the crash is not the same truth from the day after. How do you go about knowing what signal versus noise? I mean, I'm sure there's a degree of technical analysis and some fundamentals, but there's a lot more noise than signal when it comes to trading.
Yes. So our particular approach is we wait for a very unique set of circumstances. So, and it does with volatility. I think everybody's missed a major trick. I feel sometimes when I talk about what I do, that I'm almost gaslighted by everybody else's not doing the same. I think, what is it that I've seen the truth? Am I being fooled? Have I confused myself? Have, placebo pulled myself into this assessment? But it just seems to work consistently and exceptionally well. And as someone who traded and failed and chased momentum and did so many wrong things. So, there's this Eddie the Eagle analogy. He was a British skier who was absolutely hopeless and everyone loved him because he came stone last by a million miles. I was, in terms of natural trader, I was the Eddie, either Eagle of natural traders. If you put a 110-meter hurdle sprint in front of me, I was the dude who came in last and knocked every single hurdle over and had sore knees and a rubbish shin and fell on his face twice. So biologically, fast, impulsive, big sugar crashes and hypes. I respond hectically to caffeine and everything. This is the worst kind of balance, emotional profile for traders. Traders have to be deeply calm generally. So I had to have a flawless system. The only time I felt emotionally comfortable in a trade is when the market moved strongly and impulsively away from my entry. Everything else made me whittler and jittery. So I had to come to, okay, what set of criteria? So great American author Stephen Covey would start with the end in mind. Okay, what criteria typically occur before you get a single-minded high volatility move away from entries? And I built my system backwards from the only outcome that I felt comfortable from being in. And that is reverse integrating myself. I ended up with what's now known as HVF method, the Hunt Volatility Funnel Principles, which is 30 years plus of development and refinement. And I recorded everything I learned. I put it up in high quality for all my community to watch and introduce all the we tooled down to, 3 layers, beginner, intermediate, and advanced, just doing one thing exceedingly well. So again, it's the surgeon versus the paramedic. We elect to have a unique set of criteria that have to be met for us to even contemplate being engaged. It has to mean a high value target is available. You can take safe refuge and observe. And when all the criteria are made, you can take a safe shot and get safely out. And you're going to have a disproportionate reward for the risk that you take. You're going to change the course of a war. You're going to shoot a general, and you've got 3 exits, and they're both fast. And by the time they even realize where the shots come, you're already over the crest of the hill and unspottable. So that is the principle. And volatility squeezes to extreme low volatility means you get a rare moment where you can put much tighter stops. So you can, for $1,000 loss on any trade idea, you can be a lot bigger with a tighter stop. Most people's stop loss systems are inverse scalping systems of losses, because the natural average true range of the market's movement typically keeps them harvesting. So they put in stops, they don't put in targets, and the natural volatility of the market sees them eventually get taken out on the only order that they have in there, which is a stop loss, and they harvest losses. And this is a problem. You've got to select really low volatility moments. And the other key thing that people need to know is that winning traders have very long hold periods on winners and very short holds on losers. So if you think about that conceptually, the people that make money are being taken out super quick on the best people, not most people. I'm talking about the best people are being taken out super early when they're inaccurate. In other words, it's not a long bleed out. Too many traders treat this as a pain contest. The male machismo, the everything. I can stand by my view, stick to your guns. That's where the military is absolutely the worst, dying on that hill, go and die on that hill. No, terrible idea. Retreat, fight another day. When the circumstances are better in your favor, you'll beat that enemy on a different day and you catching him half asleep at night by surprise. But if you're sitting there underarmed, under ammoed, and he's fully fresh and he's coming at you and you've just marched 100 miles to get there and you're exhausted and they've got more than you, there's certain fights that shouldn't be fought. And people don't get that. We tend to enact machismo. I did this immensely. It's like, my view is right. My view is right. So we have a belligerence and an ego that's attached to it. It's much better. So you have to learn. One of my biggest advancements was learning to take regular small losses. For those listening, when you're trading with leverage, the safest thing you can do is to never allow a massive loss to occur. And how do you take regular small losses? You've got to have tight stop in an environment where it has a chance of surviving, because the volatility of the average market has got so compressed that there's very little going on. So I get interested when things are utterly bored. Most traders are chasing movement, and that's the problem. They FOMO in, they chase into higher volatility environments, and how do you project targets and how do you project stops? So this is an inversion philosophy, which is truly contrarian to most people's natural biological impulses as led by dopamine. And this leads us into the other topics that have to be discussed. Is there's a drug effect in engagement. That is why people face compulsion to be in the market. It doesn't feel like work if you're not in the market. It doesn't, you adrenally stimulated. It is the excitement of your day. And it's like, that's casino effect. You pay for your entertainment. You always end up paying for your entertainment. Your free drinks, your entertainment, your place at the casino, looking at the waitress in the skimpy dress. You pay for that. Somebody's paid them to put them there because you're on the wrong side of a probability equation. My game is you got to de-casinoize and put yourself on the right side of a probability equation with high rewards and short risk when you select the moment that is on and that is your one power over the much bigger players. You get to choose when you play. You get to choose. Now imagine there was a casino and all the low numbers are out and there's only 10 left in the pack, and you get to put on the back of somebody else's box at that one moment in blackjack. Well, Our kind of trading is like that, only better, and the probabilities more enhanced, and the rewards potentially even bigger. So on an XRP trade, if we get our eventual target that we suspect, which would be 17, with the original entries that came in that we placed pre the judgment, that was actually the first trade that will record an R of 683. I've never heard anybody register that. It's on our chart. I still have entries in there. Yes, we've got a long way to go. It's only trading at 70p, but we have an expectation. If that materializes, I'm in the game for that. And the actual probabilities are far better than 1 in 683 imply. That still doesn't mean it's a probability. It might be 10%, but you should take every 10% at that kind of reward every time. Let me let you respond there.
The point about volatility in stocks, I think, is interesting. Volatility can be volatile, right, as we know, and can very much differ by asset class. So where is your focus? You're focused on the equity side or the commodity side, and how do the stocks and volatility dynamics differ?
This is a very common question that I get, Michael, and I want to highlight to you the amazing thing about being price behavior orientated is that I don't see silos. Everybody's sitting in a horizontally siloed world. So your framing is totally different to mine. I started that way. I look for conditions. So I have a horizontal cut across all the silos. I've had unbelievable trades and losses in every major market. FX, we called the Euro Swiss franc crashes in 2009. That was the precursor to major macro events. Before anyone had heard of the Greek crisis, I went on holiday and I was in SA and I switched my laptop on and here was this huge spill in the euro versus the franc. We've done that twice. We've had the oil digit to single digit trade that actually was a precursor to COVID. The amazing thing is do this on big time frame charts and you actually are trading all the markets. And there was an equity short on Carnival and Plains Pipeline. There was a commodity short on oil. There was a cross pairs gold oil, long gold short oil. There was, it was every market. I am a macro technician. So I look at myself and I suggest everyone should do this because you could be anywhere. You sit on top of the world. You need money, FX money, investment. You can place your chips anywhere on this table, but look for the criteria. So you can set ever more stringent criteria when you have an absolute plethora of markets that you can engage in. Obviously, that means you might have to have funded accounts in that, for example, Interactive Brokers may not offer crypto. A commodity trading account won't offer Apple, et cetera, et cetera. So that does complicate at some level in that you need platforms and you might have a division of funds, but the criteria are the driver. So I'm a criteria trader, not a market trader.
I share the same mindset. It's about conditions. Conditions dictate probabilities. Probabilities dictate outcomes. So you have to think about the conditions. Now, I shared in the Nest at the very top of the Twitter space, the tweet you put out said, this is 8 years old. They're more relevant for this year. I don't want to go through these one by one. Macro demand destroying event. Sounds dramatic. To me, that sounds like a credit event, which is my belief for what could be still coming. But lay out why you think that's a condition to kind of keep in the back of investors' minds here.
So we actually run 3 brands. So, our logo, nobody cares about other people's logos, but there's a key reason that we do that. There's 3 circles that we consider. We have the crypto sniper. We have the market sniper, which is the technical criteria of trading traditional markets typically. Crypto is obviously for that particular new world money that I see coming, and the reset sniper. So the reset sniper is the lack of sustainability in our existing system. And it's very focused on the fact, and we've been in this space for a very long time, and we're potentially a bit of a conspiracy theorist at one point, and now largely most of those things are turning out to happen. So the reset sniper is saying that you are going to live through a transition cycle from one system to another. In fact, you're already going through this right now. Everybody thinks it's going to be a single card to drop. It's a bit like subprime. There's a whole, everyone thought it was Lehman, the moment of Lehman. That was all it was. That was the card drop. It's more about a camel's back. It's like there is always a final straw that breaks the camel's back. And that's how it will be name tagged, like subprime would be maybe the events of Lehman. But the whole load up, the whole setup of, the robo lending, everybody gets a house, even on welfare checks. That was all part of an eventual crash. It just, some of those things are longer projected forward. If you're doing ninja loans, that doesn't end well. But if you're passing the risk to someone else and you say, after me, the storm, sort of Louis XV, you're baking a landmine field for somebody else to walk through. And then you end up realizing that your bank's bought that same asset back class, and that landmine field is something you're also going to have to walk through. So in essence, they were all part of the setup. But the moment where everybody realized it and it got main streeted was, the events of Lehman, but there was already huge trouble occurring before. And yield curve inversion had occurred. I remember these moments very clearly because I'm using subprime as an example because I know, some of the audience may not recall 87 and some of the, the Asian crisis, but most people were around and remember what went down on subprime. And there was full-blown yield curve inversion that came in 2000, as early as late of 05 into 06, and then back again in 07. And these are leading indicators of deep credit stress. You mentioned credit being probably one of the biggest things, and I concur with that. But there's so many other places. There's derivatives, there's the retail consumer is currently a bit crushed. Your question was the demand-destroying event. What do I see? Well, these rapid rate hikes are definitely taking their toll on the consumer. We did go into a recession. You don't get to change the rules of a definition when it suits you, but that is the nature of people that are in control. They rewrite history and they bend it and they lie, and then you get lies, damn lies, and statistics. They change the baskets. They remove all basis for natural comparison, which is why I look at Shadow Stats, another US provider who runs the inflation, the BLS stats, only as if it was 1982, Ronald Reagan stuff. So when you do that, you realize that inflation is far higher, growth is far worse, and that actually the money supply has continued to grow, even though they've told you that they're tightening. There are rates-based tightening, but the fiscal aspect is they're continuing to proliferate because the banking system would fail. So we are far worse off. It's always worse off than what they tell you, because the whole game is don't stampede the sheep. We need to control when they get to here. And when there's big problems, we tell them everything's okay. It's like the parents, saying to the kids, everything's fine, when one of them's being threatened by a drug dealer or whatever the case may be. It depends on the movie. The natural thing is calm the herd. So things are far worse. And I'm comfortable with knowing that and taking action on that. And that means there is a demand-destroying event. One of the ways, if you understand their final objective, which is asset-stripped populace, you're talking about NFTs and all the blockchain type things for proving your asset ownership. First, they're going to crowbar that in. And then the purchase of those NFTs where they can proliferate a token, and that makes them at the blockchain level, the new owner. Then physically they can come and take ownership and turn you into, tenants in your own home. Now that might be a bit dark and a bit horrible, and people don't want to hear that. I'm comfortable with draconian psychopaths doing what draconian psychopaths will do, because I want to be able to prepare for that. And if you can't accept the fullness of the truth, you can't have any hope of accepting the fullness of the defense mechanisms you probably need to put in place. So demand-destroying event is part of, we had a massive expansion, which was the Goldilocks economy, and it is as the long summer ends, so the lengthy cold winter begins. If you're in the North Pole, you don't get 6 months of light without having to later sit through 6 months of dark. Otherwise, you've got to move out of the North Pole. And that's kind of where we are. We had a 40-year Greenspan Goldilocks economy. It's probably the biggest economic criminal against humanity that I can think of, and the proliferation. And he started a trajectory that all the other Fed heads had to continue. And we're coming to the giddy end of that, and it's going to get disorderly. So that's why we discuss a demand-destroying event, and that's why we believe it should be physical, just as they're pushing everything digital. So that's quite a long answer to that question, but it'll also give you quite a bit of color around that.
No, and I put out a tweet saying, people only care about the yield curve when stock prices are going down. Right. They don't care
That's
about
right.
the yield curve being as inverted as it is now that, the S&P is pushing higher and higher, right? But it seems to me that going back to that point about, being a truth seeker, you think that the yield curve is sort of the ultimate truth.
Well, I look at track records and facts. I'm unemotive. I don't look at personalities and people and presidential types. I look at the hard facts. And the hard facts is we've not since the 80s, you'd have to go into the 50s and 60s to get the extremity of yield curve inversion that we have now. It's superseded .com, it superseded subprime, it superseded the precursor to the CV19, which occurred on the repo markets in September, October time last year. All of these, and what goes violently down will return up. So it's geometric. The one thing is true, and if you look at the great minds of past, Plato, and you search for truth about the history behind religions and various other things, You start to learn things. The real subjects I used to teach were astronomy, geometry, mathematics. And geometry in charts holds very true. Our entire targeting system is based off the violence of a move in one direction is typically commiserate to the likely violence of the move in the other direction. So people overshoot. The more leverage there is, then the more extremity in the system, the harder it overshoots. And therefore, when it overshoots unnaturally far, the nature of the correction will be equally violent in the opposite direction. And there's a natural geometry to the price charts. So in terms of your question, the inversions is the most violent we've had in the modern era. So I'm going, from the Volcker 80s highs, which is some 40 years. That's fair enough to sort of draw that epoch. It's the most violent and deepest. And that points to, this is reset, guys. I would go, when reset happening? It's happening all around you. All the precursors are there. All the fuses have been lit. I mean, if you're waiting for the controlled demolition, it's on its way. It can't be stopped. This can't be stopped. This collapse occurs. Even if everyone started pushing sound money policies and did 100% pivot to exactly how I do things, there's no turning this oil tanker around, in my take.
All right, so that lends itself to the point too, which is likely a bank failure on a scale on C. Now, you had a little scare in mid-March. I was very cynical about the way the regional bank dynamic played out. To me, it was one of those things where it's like, how do you have stimulus when you have high inflation through a manufactured banking crisis? That was a tweet I put out back then, which people thought was conspiratorial. But the truth is, it gave the policymakers an excuse, right, to start doing some stimulus with high yield, given the way that the Fed and everybody kind of stepped in there. But
they also consolidated the banking system into their big primary dealer players as well as part of that. On very beneficial terms, by the way. JP Morgan was given money, taxpayers' money, and was given the opportunity to purchase below market assets at an extreme low price. And the usual skullduggery, fraud, and legalized insider rape and pillage, I would say, plunder, rape, and pillage.
Okay, now, but one could argue that, that concentration of banks, the too big to fail dynamic, so you're not going to have that, at least in the U.S. If there's going to be some kind of, real tail event in the banking sector, do you think it outside the U.S.? Could it be something in the Eurozone, something with Asia? I mean, I think it's probably something more outside of the Fed's control.
I will question the validity of almost the question. It's such a complex system and so clearly compromised in so many ways. They can determine what is that first domino to fall themselves. And it's going to be very hard for any one of us to guess that correctly. The key bet, I want to substitute your question in a way and say, I don't think we have control over knowing that. And I don't think knowing that actually changes anything too much. The fact of the matter is it will run through the entire system. It's a bit like asking, we've got petrol throughout the entire apartment, and explosives, which one will be the one where the fire's initially ignited? Well, you'll hope that maybe it's not yours, but the whole point is the whole building goes, and what's the defense? How do you protect against it? There will be something. There will be a seminal moment. It will get its tag. I refer to this as a toe tagging. If a dead body is a problem, and then they go, oh, it's Joe Schmo. He was hit by a car. He was a homeless person, and everything's then fine. It's the mental cognizance of the not knowing, and they will give you a narrative, and they will give you a storyline. The point of the matter is that everyone goes, oh, okay, at least we know. And, I'm not a homeless person and I wasn't drunk stumbling around the streets. It wouldn't happen to me. And that kind of gives the comfort. And it's just, you can't have a body in the morgue without a toe tag. I think we shouldn't focus on the toe tag. We should have focused on the fact that there's a death coming. And the point of the matter is you don't want it to be you in a fiscal sense, in a financial sense. And what is the best preparation you should be taking personally and for your family and friends? And what counsel should you give to, others in your peer group in effect to mitigate against what is going to be the largest single globalized economic event that's ever going to befall us? Because up until now, the depression in the States in the 30s, there wasn't that same bite in Europe. Yes, there wasn't great economic times, but they didn't go into a depression. Now we are so intertwined. This is going to be economic case history for centuries for people that study that topic, if it's still allowed. And I think we're going to a global centralized system. My big concerns, the things I'm watching, that tie a little bit into this is, if you listen to Fink of BlackRock, and these are the people that listen, they do give away some truths in some of what they say. Of course, they're deception agents as well. They'll refuse to answer what they don't want to answer, but they do give some truths. He is applauding blockchain predominantly without overly going in. He wants to do a Bitcoin ETF for sure and all of this stuff. But the thing, if you listen to what he likes, is he says this is transnational money, no longer affected by any independent state. So if the dollar goes bad or America goes bad, this is something that transcends the border. So this is very New World Order. This is a globalized system. And then the other thing he emphasizes is, and we can have identification and full beneficial owner knowledge on everyone on the chain. So what they want, and why would people want that? This is a globalized tax extraction goal. They want you identified by Iris. There's a guy, Sam Altman, who is putting into play WorldCoin now, and he will dish it out. You just have to get your iris scanned and be proved that you're not a bot. You know, there's going to be more bots now because of ChatGPT. This is personally, biometrically pinning you. And that then means they pin you as to where you are, pin you as to identity, and you will then be pin owned by a nation state still in terms of tax extraction that will eventually transcend into this globalized system where all your assets will be on blockchain. NFT it is, and this is where they're taking you. So you have to understand it. Then you see then you see the woods for the trees. And actually you need dark money. You need stuff that's not going to be on the blockchain for this. Because eventually once they've clipboarded everything you own, and it's got an NFT attached and it's on the blockchain and every assets and how much gold and how much silver and all of this. And they'll say, well, we have custodial systems. It has to be checked and scanned to make sure it's accurate and all of this. And then it's, we're putting gold at this price. You've got a capital gains to pay on it. You might need to sell some, or hang on, it's been deemed a transnational. But what's happening is national boundaries used to be your protection, actually. If you left a state, you could escape the system. The actual transnationalizing of a system means you are in an encaptured prison cell in the world, a prison planet now. Because now, as a nomad capitalist myself, who's sitting in Panama, who has a territorial tax system, anything I earn outside of Panama is deemed offshore income. And this is something they want to stop. They want to stop. Some of you might say, yeah, I'm glad they're going to stop it for you. No, it's what they're going to do to everyone. And they're going to extract you and up the rates and squeeze until you are forced to sell your assets to just cover the tax extraction on those assets. And they're going to be able to do real-time tax extraction. They can do a mark-to-market spike on, gold. In fact, there were people in Bitcoin when it ran up, I think, the first time to 20K that had larger tax bills than their Bitcoin was worth after it crashed down to 3, that they actually had to sell it all off and still owed the tax man on a mark-to-market basis. And they never got, you then go, you have to wait another full year for where it is to try claim a rebate against what you paid on capital gains. So the point of the system is they want to put you on the wrong end of a compound interest equation. They want to put you on the wrong end of an extraction mechanism, and they want to take everything you own away and turn you into a tenant. Everything has gone subscription model. They want to turn you into a tenant in your own home, and they will own the assets and will have you as their subscriber on every level. And if that's your understanding of the end game, then you've got to prepare accordingly. That's the reset part of my brain speaking right now. It's not particularly markets orientated, it's preparation orientated, but from a fiscal point of view. And I think maybe I'll let you respond to that.
Yeah, no, okay, and I'm glad you made that distinction at the end because we went from trading to sort of get out of the system, which, by the way, I don't disagree with that at all. But that's more of a buy, hold, and don't worry about type of dynamic versus active trading. So so gold and Bitcoin are seen as the answers to, in quotes, getting out of the system. But presumably, you're still trading around them. So do you have yourself an allocation that you just hold on to because of that reset part of your brain, or do you trade around them in some way?
So I have the physical assets. I elect to have physical assets in multiple jurisdictions for whilst that arbitrage exists, although I don't think it will exist forever. In terms of, Bitcoin being your guaranteed certainty and safe haven, I have a few reservations on that, but I do think it plays a role. I think it was created. I don't believe the Satoshi Nakamoto. I've said this many times before to most people. Initially, in the early days, everyone, Bitcoiners distrust, but now it's less controversial. This notion of this benevolent developer that did all of this quietly disappeared, can't be traced, and left all these in a wallet. I pretty much expect Vanguard and BlackRock at some point to become the custodians of that. And that will just be, new Rockefeller, Rothschild money. And it'll just be like a big vault of bullion. It'll be the Fort Knox of gold, only at a global scale in a different mechanism. So this whole thing that it's been positioned, this whole concept of mining, it's been positioned as digital gold. And I think that part, it served the purpose of keeping people out of physical gold, because they do probably want to own all the physical gold in the world. And I think the big decision is you're going to have to be black. They're going to want you to register, and they're going to make it punishable, I think, in due course. Eventually, like they try to do with the vaccinations in COVID, that everybody has to register assets. It's going to become an obligatory thing. It's be voluntary at first, and you'll get tokens and gifts and incentivizers, and then it turns stick. And in actual fact, I think, you need to resist that and do that on the one side. But your question was more about back to markets. I trade to make alpha, which is on top of investment. So I have an investment. Everyone should have a pyramid, and the base and the most important part is actually the foundation, not the apex. The apex is what gives you the height. In the dollar bill, the eye, if you want, but actually the foundation should be investment. You don't have that vantage point on top of the pyramid if you don't have investment. That's unleveraged. And I actually take this into property as well. I warn that interest rates are one of the most powerful tools of spontaneous destruction to your personal finance. And the possibility of a disorderly decline in the dollar then leading to a disorderly spike on an interest rate spike as they add ever more volatility into the system. And the Fed and central banks are not calmers to the markets. They are volatility introducers by their no-pain economy and build up dam wall bursting crises. They are actually introducers of volatility into the market. And inflation is a policy. It's a chosen policy, not something that they pretend to fight against. So if you understand these two things conceptually, possibility of a violent interest rate spike, which could see anyone with leverage, you might have a fixed rate even on your home, but there's probably some degree of force majeure on some of those where they could break the fixed rates. It's best not to have debt in your life. So in terms of asset management, have no debt. But then, so if you're debt free and you've got physical assets in gold and silver, and you can certainly hold some Bitcoin in a cold wallet, etc., I then trade off with collateral those unique opportunities that we're describing that go with our methodology, that's hunt volatility funnel method. And there's crypto markets give very clean charts. Most markets I love and enjoy. So we select and we aim to make alpha out of all of that. And then you still there? Good, yeah. And then we tax down into our investment pot. So the goal is the bigger the base, the higher you can build up. If you think of Burj Al Arab, the building, they actually have a massive base and foundational strength. So you've got to keep building your base, as not just go for height. And when you start building too high, and you've got to earn the right to leverage, you start building too high, which is the leverage, getting up to that peak point, and you just this very thin spire or this ladder, you get blown over. And then you crash down hard. So you need to, at every gain on a leverage level, you should be taxing down into a lukewarm to a cold pot, which is no leverage at all.
Okay, let's get a little bit into what you're expecting in gold in particular. I am of the mindset that we're probably in a prolonged bear market, that we're still in a bear market to take time. And what would probably happen is, if I'm right on that, large allocators will start looking for diversifiers. Gold would be among them, uncorrelated largely to everything.
Did you say the gold is the bear market?
We're in a bear market for equities, right? Because
okay.
Most things co-move to beta. There are very few diversifiers against equities. Gold is one of them. So if you have big money believing that you're in a prolonged bear market time-wise, then there's going to be a reallocation to gold, and that kind of sparks a self-fulfilling momentum cycle, at least in my view. But how do you look at the path and sequence of gold? And you mentioned targets before. I'm not a huge fan of targets. I don't believe necessarily it's that easy to get them. But how do you think about gold going forward?
I'm positive the outlook for gold. Typically, so when we broke the $1,000 mark, we broke it once technically, and then we pulled back. Then we had a sustained period tapping up under the $1,000 mark. This was now quite some time ago. We touched 3 times, and then on an ascending 8-year structure, we went very low volatility. And I remember specifically the Monday, the 2nd of September, it essentially was the first big bank, the bankers back at their desk day. We had a really strong volatility expansion from a very low volatility market break that took us smashing through the $1,000 mark, never to be seen again, even in the subsequent pullback from the 1972 highs where we traded right down to, I think, 1080s level. So we did have a substantial long correction. You could argue a medium-term bear market on gold. But if you have a big enough time frame, gold is a macro bull, and in my opinion and take. And I think we're about to do to the 2000 mark what we did in the 1000 mark in that year. I'll just check the chart to get the exact correct date when that was. So I'm not just talking out of my hat here. When was the famous break? There we go. It was '09. So it was the '09 year. And that was actually a terrible year for people's optimisms, by the way, in terms of that. People were it was a great time to be getting into equities it was the doldrums of the post-dot-com boom. And of course, there was QE abundant. And we've already benefited to some degree in part on the QE post-COVID. So the proliferation game is going to continue. And this is going to continue to fuel a macro bull market for precious metals and physical things in my worldview. So I think we've had the 3 taps now on the 2001. And I think the next move up, we breached 2000, never to trade it again once we and we could breach it impulsively. And I think that's going to be a great thing. And I think the next stop is 2,900, and we're going to have a staging post, much like 1900 was in 2011, for the next move through $3,000. And that's going to be doubly bullish for silver as well.
You need to have the dollar break for that, or can it just diverge from the current stack? Because that's the narrative that you often hear, that you need to have a weak dollar for gold to move higher.
We do refer to gold as the god market of the anti-fiats, and the dollar as the king of fiat. Sorry. So there is an adversarial role in that. You know, when you mentioned the markets or bear markets, the one thing I'll warn is that such is the hyper stagflationary event that we are in. It's despite the valuations being disproportionately high, especially if you think of the likes of Nvidia, in a stagflationary environment, the biggest problem is the debt markets need to be deflated. People don't talk a lot about this. And I've also learned to focus far more on debt market. It's the counter, it's along with the FX markets, they are the giant market. And what's happening at the moment is we've got so much debt, and let's take a simple bit of mathematics. Think of this as a household. The US had 89 billion the month before, and now at just under 300 billion trade deficit in a single month. So you've gone from sub 100 to almost 300, 3 times in trade deficit. Tax receipts are down substantially, and outgoings and welfare payments are immensely up. And you're just starting to hit the high interest payments that are due following the interest rate hikes that you've done to curb inflation. So the government fiscal position, I'm talking about the US government fiscal position, is so bad that they have to issue more debt. So how do you bridge that gap? It's a bit like you've got a 30 grand credit card, or you're earning 30,000, or there's something more realistic, 100,000 a year, and you're spending 250. The rest is going on your credit card, and that's the bond market. So this huge wall of new debt is coming on all the time, and all existing debt is rolled. Nothing is ever paid off. So the biggest absolute blowout mega bubble that is hyper overvalued, that needs to literally go very close to zero, if not entirely zero, is the bond market. So what happens when everybody realizes that? So we called the bond turn with the March 2020 events. We said in August, that's it, it's turn. We're going to see it technically. You will never see rates like that again. So we have to have stubbornly high rates, because otherwise you're not devaluing the debt. And if you bring the rates down a bit, as recently happened on the bond markets, the treasuries, the 10-year, they brought it back down. Well, then the dollar starts to take the hit, because you're creating so much new debt, you're running so much deficit. So because of the unique position of America, Chiffin's dilemma, meaning essentially you export dollars and you buy everybody else's products and goods. When the deficits start to grow so much more, you're funding that with more debt. The debt market is accelerating in its proliferation. This is non-sustainable. So the debt market is actually the biggest problem, and it also drives the currency market. So what ends up happening is, if you're adding debt at a faster rate than other nation states, your currency declines at a faster rate. So we've called for a break of 97. So we had a Dixie break call that we made at 103. around about Friday of our live trading day on the non-farm payrolls. That was the beginning of the first miss and undershoot. So 4 things have happened. Powell didn't increase rates. You undershot on the labor number that you'd beaten, and it surpassed 14 times in a row. You didn't get number 15, you undershot. You then had the following week an undershoot on inflation. So you did 3 instead of 3.1s where everyone was expecting. There were basing effects to that because you were comparing it to a year ago when the rate was 9.3%. So yes, you're not going up as fast, but it was a localized high there. And then you had an undershoot on retail number. That was just last week, just the back end of last week. All of this points to consumer slowdown. And as a result, the non-increase of rates means you're not going to be allowing the debt to devalue anymore. So the currency takes the hit. So money is borrowed into existence. You've got 2 release valves, currency, rates. So if you're not increasing rates and taking the debt in a measured way down and devaluing it, you're going to get a hit, especially if you're increasing the amount of new debt you're creating. And that's the dollar's predicament. So initially, while sympathetic to the possibility of the dollar milkshake theory that Brent Johnson espounses, initially I'm seeing a very bad spell for the dollar. I'm seeing 97. We're getting into 97, and there could be further downside to that. That's going to be a tailwind in gold and silver's favor generally, and it will help Bitcoin and the crypto markets too.
Francis, for those who want to track your thoughts and your work and your analysis, where would you point them to?
Oh, thanks for that. Yeah, the marketsniper.com is our website if people want to book a call. But just to check us out first, the best places are our YouTube channel. That's at the Market Sniper. It's also the crypto handle and at the Crypto Sniper. So we run for the 2 markets, the Crypto Sniper and the Market Sniper. Check it out. See if you like the cut of our gym. And if you want to, then you can go to the website by the same name and have a chat with us. So we have a membership premium group where we're discussing specific trades. Everyone's getting trained to a certain level to understand exactly what we seek to do. We aim to do one thing very well. And my goal is to help a community of people build wealth in reset times. In other words, abnormal market and economic conditions that are going to require protection as well as building trading profits and converting that into smart investment.
Good place to wrap this Twitter space up. Thank you, everybody, for joining. And Francis, appreciate your time here.
Absolute pleasure. Thanks for asking me on.